things I'm going to address my comments to. Where is the economy? What might be its drivers going forward? Where might we? What are the possibilities for ending 2024? And then we can have a conversation around what the risks are and where the opportunities might lie. And so, where are we? What might drive us? Where might we end up? Where we are is, as I say, it's a defining year ahead. And the reason I say it's a defining year ahead is that this administration in place has started on a path of reform. Some of these reforms perhaps might have happened a decade ago. But as they say, better late than never. Okay? First point to make about reform is that reform is not without a cost. And at the heart of, in my view, of the government's challenge is going to be how does it first sequence the reforms, second, manage the costs of reform. Because if nobody knows anything, fuel prices went up from 200 to 600. It's part of the reform. The president in his comment said, are we going to see higher fuel prices? That is a question that perhaps only government can answer. If I was to say anything, it would be in a liberalized market, your fuel price will be driven by three things and three things only. The first is what's the price of fuel? The second, if we're importing it, what's the exchange rate? If we're not importing it, it depends on at what price the producers, now we have the Dangote refinery in operation. And of course, the third piece will always be taxation. Is there any taxes? And so ordinarily, if global crude oil prices move up and down, fuel prices will move up and down. By how much? It depends. And that's why I say that's where the policy makers' intervention. And some would argue that, look, part of the challenge we faced before now in not taking out fuel subsidy fully before it was done is simply that we had ended up borrowing to pay subsidies. If you look at the numbers now, the FARC numbers have gone up quite significantly. And so when you say, where are we? At the beginnings of reform. But the context of the reform is an economy growing, let's not misunderstand that, growing, but unstable. Stability in any economy sits on a tripod. What's the tripod? It's a tripod that measures, first, where is your output? Is your output growing faster than your population? If your output is not growing as fast as your population, then income per head will come down. And so that's the point about your productivity must be bigger, grow faster than your population. That's the only way you grow your income. So that's the first leg. Second leg, costs must be stable. And for Nigeria, indeed for most countries, there are two dimensions or two domains of cost. First is inflation, second is exchange rate. So that's why the point about exchange rate stability. I'm much more particular about how stable is it. And typically what has happened to Nigeria is really very simple. We hold and then we drop. We hold and then we drop. Whereas what we perhaps need to see is an exchange rate that is more in tune with the forces of demand and supply. Please don't misunderstand me. Every country in the world manages its exchange rate. How they do it is a different matter. But nobody, quote unquote, leaves exchange rates, to whatever you like. It's a very important price. And so for me, what's important is that stability. It's important to understand this, that yes, for me personally, I would like the Naira to be very strong. Why? I have school fees to pay. There are medicals to pay. There are house mortgages to service. But if this economy is going to grow the number of jobs that it needs, the UN projects that we're going to be 400 million plus people by 2050. Question is, where will you find the jobs? And let me be very clear, Nigeria's job prospects are to be found in building a robust agro-industrial complex. Please understand that. What does that mean? We've got to build an agro-industrial complex where agriculture provides the feedstock for manufacturing. One of the fundamental weaknesses of where we are today, when you look at the Nigeria Bureau of Statistics numbers, only 6% of Nigeria's labor force is in the formal sector. 93% or thereabout is in the informal sector. So you need to begin to formalize this economy. We need to understand that informal sector, by the way, but we need to formalize the sector, the rest of the economy, so that's the only way government intervention can actually be more deliberate and more effective. But as I was saying, stability is three things. Output growth, driven in part by productivity, price stability, which is why I would argue that the central bank's shift of focus to managing inflation is probably the best thing that they can do. And they must be supported. It's going to be hard. Please let nobody misunderstand this. If inflation is about 29% and you're going to bring it down, I don't know, you don't have to be an economist, but I suspect that many people in this audience either read O.A. Lawal or read Professor Terry, read Professor Teriba, yes, Professor Teriba of the University of Ibadan, either in secondary school, and they taught you at least one thing. It's either too much money chasing too few goods. Abi? If you didn't remember any other thing, you remember that. So it's the same thing. If you want to bring prices down, you're either going to increase supply, or you're going to reduce demand, or you're going to do both. In the short term, it is easier to reduce demand. Why? Because to increase supply requires investment, which then grows the economy. There is a lag. And that's one of the key points that I think it's important for the government itself to make on a continuing basis. Reform offers us a lifeline, but it takes a time. It's important. Imports in Nigeria amount to about 12% of GDP. Ghana is double that. Morocco is 4 or 5 times that figure. But we need to be able to export. And to do so, I go back. A globally competitive agro-industrial base is what Nigeria must build. Now look at this. This is Nigeria's inflation. The red is the US's inflation. That gap, when people say, what's going to happen to the exchange rate? I say, I don't know. I don't ever predict exchange rates. If I wasn't taught anything in economics at master's and postgraduate level, I was taught never to predict oil prices and predict exchange rates. So I don't. But I can tell you, economics is very clear about what's going to happen. Or, no, not what's going to happen, what should happen. Policy can intervene to ensure it doesn't happen. But look at that gap. You're looking at 29, you're looking at 3. The gap is 26. What it says is essentially the Naira has to move. There's something called the law of one price. The Naira has to move to cover that gap. Which is why the central bank's determination to reduce inflation must be supported. Because unless you bring that green line south, the weakness of the Naira is going to be very difficult to stem. And by the way, just in case you are all looking and saying, what happened? What happened is not difficult to understand. Liquidity, money supply, grew last 8 years on average 14-15% per annum. Output growth was 1.2% per annum. Go back to O.A. Lawal. Too much money chasing too few goods. I hope you understand me. That's the challenge. And by the way, look at the graph below. What that is showing you, it's not that difficult to understand. On the one hand, all the red pieces are bond yields in different countries. All the blue pieces are inflation. Look at Nigeria, inflation well above bond yields. I hope you can see that. So I've already shown you this one, which says if it's like this, the currency is likely to move in a particular direction. So don't be surprised people are looking for foreign currency. But look here, if yields are significantly lower than inflation, then why do you want to keep your money in Naira assets? Again, it goes back to that point about the imperative of managing aggressively inflation downwards. It's going to be painful, but in my view, we have no real choice. That's the definition of the context into which we have entered 2024. So the question now is, what's going to drive 2024? Anybody who's listened to me in the last God knows how long, so if you've seen this before, forgive me, life kind of happens. This is just my own view of the world. Nigeria's conditions are affected by global stuff and domestic stuff. The global stuff, policy, trade, capital flows, diaspora transfers. The domestic stuff, activity costs, but at the heart of it is policy. So now let's move forward. So what I've said to you is global things, local things. What are going to be the global things? Well, the year ahead is looking rather interesting. Democracy is going to be under test this year. I'm told there are about 70 plus elections around the world. And that these 70 plus elections will have national populations of about 4.2 billion people voting. So this is probably the first year in a long time when half of the world will be voting for leaders. Now, whether democracy delivers governance, that's a but that's the first point to make. And why do I make that point? Because artificial intelligence and its use or misuse could really play a very interesting role in that. But the piece that I am more concerned about are the pieces on the diplomatic side. Because the world is seeming to me to move away or to move in the direction of less peace. We've been talking about Russia, Ukraine, now we're talking about the Middle East, potentially globalizing a conflict. We're beginning to talk about China-US tensions on the back of Taiwan. There are some interesting pieces that I think everybody needs to take cognizance of. As businesses, cybersecurity becomes important because I see here we don't really pay that much attention to cybersecurity, but I think it's going to be interesting. What do I think is going to happen in terms of the global economy? Remember I said it affects the domestic economy. The global economy is slow. The rate of growth globally is still looking at about 2.5%. And guess what? 2.5% is historically very low. Indeed, 2.5% is almost a global recession. But global inflation is still high. It's coming down, by the way. It was 9, it's come down to 6, but even at 6, it's still higher than what it was pre-COVID, which is why global monetary policy is likely to remain tight. Global monetary policy remains tight. If you're looking to so you have two questions to ask yourself. One, what happens to the Naira? But an even more interesting question is what happens to the dollar? Not against the Naira, but against other currencies. Domestically, what's going to happen? Again, what I have seen are projections that range from about 2.8 to 3.7%. So I'm going to stay in the middle. I don't forecast any of these things. I'll take 3%. But all that the projections are saying domestically is very simple. we're likely to move away from a diminishing income per head. Because remember what I'd said earlier, imagine a cake. The cake is growing at about 2.5% was the figure for the year so far. And the population that will consume it is growing at 3%. Then it must mean every partaker of that cake will get a smaller slice. It's as simple and as straight. That's what diminishing per capita income really means. What I expect us to get to this year is where that diminution stops, where we see GDP growth hopefully matching at least, but preferably exceeding population growth. As for inflation, inflation should come down. And the central bank said to us, look, the IMF's projection is that the average inflation rate for 2024 is going to be about 22%. And that it will end the year at 15. That's the IMF's projection. Why? Yeah, because the central bank is going to tighten up. Tightening up by the central bank means you're going to see higher interest rates. Indeed, what I would like to see is an inverted yield curve. Why? Normally in economics, yield curves are upward sloping. But I would like to see an inverted yield curve. Why? Because I'd like it to be high at the short end and lower at the medium to long end to support investment. Now, that one is great to need. If the government believes that what I'm saying is correct, or if that's the way they're happy to go, they're going to have to figure a way of creating an inverted yield curve in order to support growth whilst at the... So in other words, what I'm trying to do is say, look, is there a midpoint where we're able to not choose between fighting inflation and growing the economy? And my suggestion would be, if you can get an inverted yield curve, then with not, as I say, yield curve upward sloping, this one upward sloping at the short end, and then downward sloping at the middle point, and then can do whatever it likes beyond that. So inflation down, but it's not going to start immediately. Probably still for the next 2 months or so, we'll still see the impact of rising inflation. The outlook is actually, even though we don't like it, dependent on oil. That we need oil production to rise, the revenues therefrom to provide the dollars that the economy needs to fund itself. And by the way, let me also make the point, because sometimes everybody jumps up, this thing about exchange rate, I think sometimes we need to understand it in a bit more contextual terms. The Central Bank of Nigeria is 38% of the foreign exchange supply into Nigeria. Now, careful. And Doyin Salami, careful, careful. If you look at the data, and I looked at the data from 2008 to 2022, so it's an average over sort of like a 12, 14-year period, that the non-central bank sources of supply are actually bigger than the central bank. Okay? The only thing, though, is the central bank is the biggest single pot. Nigeria does have some built-in resilience. The key question is going to be, what do we do to stimulate confidence and enable the flow of foreign currency? So at the heart of 2024, in my view, is a need for government to enhance confidence in this economy.